Good evening, everyone, and thank you very much for joining us this evening. Tonight we're talking about an opportunity, an investment opportunity that will give you exposure to possibly the strongest international economy and market, and an investment that can perform very well when there is economic uncertainty, and an investment with limited downside risk but uncapped upside. It's been a very popular investment, and I'm looking forward to running through it with you. My name is Patrick Nelson. I'm the Managing Director of Reach Markets. Reach Markets, we have offices here in Melbourne and Sydney. We are involved in numerous international investments. We're the education partner to the Australian Stock Exchange. We run one of the busier options trading desks in Australia and have the leading technology. We manage numerous ASX listed companies, IR, and we also have a range of high yield investments, and we work closely with private equity businesses as well. So we do a range of different things. There is a team here in Melbourne and a team up in Sydney. Any advice contained in tonight's presentation is general only. It doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it's appropriate for you. Past returns are not an accurate indicator of future returns. The investment we're talking about this evening is a structured product, and some of the details of that business that provides it were up on the screen there. Now, why do we look for international investments? Well, there's a number of reasons. We look at the US market. I guess, if you look at the Australian market, we've got massive exposure to banks and materials, the mining sector and so forth. And if we compare that, say, against the US market, which has been going up in leaps and bounds, information technology, 24%, the Googles and Facebooks and the other businesses and the like, disruptive technologies, global businesses coming to solve in our global economy, coming to solve problems not just locally in their domestic environment, but across the world. And so I guess we're not saying Australia is not a good place to invest. There are lots of good opportunities to invest in Australia. There are lots of good reasons for investing in Australian companies. But we do, if we're looking at the bigger companies, often need to look beyond our shores if we want to get exposure to the best businesses on the planet. The way things are going these days, if we looked at the return of the market, I mean, this is not an up-to-date chart. The Australian market has done all right recently, but nothing like what the returns that have been available to the US. This investment also has gold in it, right? And I'll explain the structure of the investment as we go, but gold performance has been very strong, and there have been numerous reasons why that has been the case, but gold is an asset that can be seen as a safe harbour in times of high economic uncertainty. We see how well it performed in 2008, 2009 and beyond. It is an investment that can do very, very well in times of economic uncertainty. And so whilst the markets are looking technically very, very strong, we've been in a strong bull market. We believe we're still in a very strong bull market. Gold, there are things happening that if they escalate and economic uncertainty escalates, gold is a very good is something that you want some exposure to. So this investment, if you want international exposure, if you would like exposure to something where economic uncertainty could be very favourable to it, and if you want something with capped downside, this is what that investment is designed to give you. Now, I'll run through the numbers behind the investment, and then I'll get into a little bit more information about it. But just so that you can understand, if you wanted to get exposure to $100,000 worth of this investment, the net outlay is $22,950. It's a 3-year investment term. Your maximum risk is the $22,950. But you've got uncapped side on $100,000. So it doesn't matter if the market falls. The maximum you can lose is $22,950. But if the investment runs up strongly, you've got that uncapped upside on $100,000. Now the investment is giving you rewards you based on the best performer. So you get $100,000 worth of exposure to gold and $100,000 worth of exposure to the S&P 500, right? So for your 22,950 maximum risk, you've got that 100,000 uncapped upside against both gold and S&P. But you only get to participate in whichever is the strongest of the two, right? So if for example, the market goes up strongly, then your performance on the market outperforms gold. Then your performance on the market is the one that you will take, and vice versa if gold does the best. All right. So if the market goes up and gold goes up, great. You choose the one that goes up the most. If gold goes up, market goes down, you've got gold. And so you play around. So there are different scenarios which you can benefit from as long as one of the two assets performs. Right, so in the scenario that I gave, you get exposure to both of these assets. Now, let's say that gold was up 40% and the S&P slows down, and after 3 years was down slightly. All right, you would take the 40%, which is 40% on $100,000. So your net outlay was 22,950. 40% return on $100,000, however, would give you a $40,000 return at the end of the period. So you would have $40,000. The coupon that would be paid back to you at the end of 3 years would be $40,000. Right? Now, let's say that the S&P 500 was up 45%. Gold stagnates, is up 9% at the end of the 3-year period. Your performance coupon would be $45,000 minus the performance fee of 10% at the end of that period. So basically, whichever is the higher at the end of the 3-year term is what your investment will pay out on. All right. So in terms of how it pays out, so if gold's up 30%, then you get a 30% return at the end of the period. If it was up 45%, it's a 96% return. If it was up 60%, 161%, and the same goes if the better performing was the S&P 500, which I think is up so far this year around 24%. So but if it over at the end of the 3-year period was up 30, 45, or 60%, those are the numbers. Now on the downside, your net outlay is 22,950, so that's your maximum at risk. If the market goes sideways or falls, whatever, that's the maximum at risk amount, but you've got the $100,000 worth of exposure on the upside. All right. Now, just to break it down, for that $100,000 worth of exposure, you pay for the 3-year period an interest rate of 5.95% on that $100,000, which is $17,850. Risk management fee and advisor fee takes the total investment cost to $22,950. So that is the breakdown of the investment. You don't have to take $100,000 exposure. You can do smaller amounts. You can do bigger amounts. Here is an example of exposure amounts. Right, so it's just up to you. You would talk to Michael Cade, is the advisor managing this investment. If you've got any questions about the investment, you just speak to Michael and he can help with the populating of the documents and so forth and setting this up for you, and you can discuss those amounts. But just going back over it, 22,950 gives you $100,000 of exposure. Your maximum risk is 22,950. Your uncapped upside is 100,000, and you're rewarded on the best performing gold versus S&P 500. Right, so whichever of the two gives you the best performance. Now, gold's an interesting one. I mean, there isn't that much gold around. Every day, the world pulls more steel. Every hour than it has poured gold since the beginning of recorded history, right? So it's a rare resource. It retains its value in times of financial uncertainty, geopolitical uncertainty. It's often referred to as the crisis commodity because people flee to its relative safety when world tensions rises, and during such times it often outperforms other investments. And the 70s were great for gold, terrible for stocks. 80s and 90s, wonderful stocks, not great for gold. 2008 saw, the market, a lot of people migrated to gold in that period of massive uncertainty. It's gone up. Recently, it's come off a bit, which is great for us getting set at this at these stages. I know the Chinese and the Russians have been, central banks have been furiously buying gold. There was another one that came into the market the other day. Ray Dalio, Bridgewater Associates is long gold. It's been used for currency for thousands of years. And we're also seeing these fastest technologies actually using a lot of gold as well. So it's setting this up at the same time as being able to access S&P 500, giving you access to some of the best companies on the planet, possibly, maybe the strongest economy, the strongest market, in a strong bull run. Great, we can get on that bull run. We get that international exposure. We've got, we don't have to put $100,000 in. So, we're setting ourselves up to get exposure to a market that could be really strong. A massive crisis comes along, economic uncertainty. Maximum we can lose is 22,950. However, we can actually, in that crisis, it could be great for gold, and gold could perform really well. So we've got a cap downside. We go into a bull market on a strong, the strongest economy, and we've got that uncapped upside, cap downside, but we've also got, a position that can benefit from major uncertainty, and we can see a flight to the safety of gold during that period of time as well. So it's a really interesting investment. It's been very, very well received by our investors. It's open for another, another 2 weeks. So if it's something you're interested in, speak to Michael Cade to get the details of it. But, you've got the opportunity to benefit from the best performer between gold and the S&P 500. You've got uncapped upside on both of these assets. Cap downside, obviously you just choose the winning asset out of the two, but you unfortunately you can't get access to both at the same time. But it's something that can be set up. Someone that's got an SMSF, a lot of people invest via SMSFs for these types of investment. Relatively simple to set up. We can assist you with that. If there's a major run on, we can close out of the investment early. There's quarterly liquidity on it. And it's something that we set up. So if it's something that you would like, you're interested in, by all means just type yes, and we'll send out the product disclosure statement. If you would like to speak to Michael Cade around the investment, just ask Michael and he can get it set up. So if you've got any questions, please just type them in, and I'm happy to run through any questions that you've got. It's a pretty straightforward investment. Okay. Let's have a look. Jeff has asked, are there any margin calls with this investment? No, Jeff, there are no margin calls. Yeah. All right, Mike. Mike, what I might do, that's quite a detailed question, is I'll come back to you with a very specific answer to that, but I might not go into that to this session tonight because it'll probably go over people's head. But absolutely good question, and I will get a definitive answer to each one of those elements. But yeah, no problem at all. Okay, so John's asked about what do we mean by crisis commodity. Look, it's a reference, John, that I guess when we've seen periods, 2008 is an example of such a period where the market has gone into, or the economy has gone into crisis mode, global financial crisis. And during that period, people were uncertain about investing in equities. They were really worried about the safety of that, and so a lot of people moved into gold as a secure asset to invest in. So that's what we mean by that. And as you'll see that how gold performed during that period of time, it was very, very strong. I'll go back to a chart of it. Let me bring that up. So you can see that during that period of crises, it went up very, very strongly, and we saw that towards the end of the 70s as well. So that's what we mean by that. All right. Okay, John's asked, can we go over again how this works with my SMSF? So yeah, John, if it's something that you want to use your SMSF for, it's quite simple. All you need to do is speak to Michael Cade, and he can do the paperwork, but it's really your SMSF. You're just simply taking it up as an investment via your SMSF. It's a product because there's a PDS behind it. There's a wrapper on it that allows you to invest via your SMSF. Quite straightforward. I'll just speak to Michael and he can assist you with the paperwork. Okay, John, how has the S&P 500 performed recently? Very strong. It's up nearly 24% this year to date. I mean, I didn't check the markets overnight, but as of a couple of days ago, that is correct. So the market's running very, very strong market at the moment, and while we're in a bull market, technically it's looking strong. I will say that there are, over the last 5 years, there have been plenty of things that you could be concerned about, and the markets continue to be very, very strong through that period. So we stay with that view of it being in a bull market. Technically, there's a lot of reasons for us to continue to have that view, but the one thing we like, there's two things that we like about this investment. It gives you that upside, but it also has that if the market slows down. The market going down is not necessarily a trigger for gold going up. It's more the uncertainty for geopolitical issues or economic uncertainty, which aren't necessarily tied to the market in a shorter period of time, that we like about having that gold in there as well. All right. Earnings reporting, I guess, also is something that 70% of the companies, S&P 500 companies, have reported in Q3, and the vast majority of these earnings have beaten expectations, which is continues to show strength. All right. Now, is there any other questions? Anything else that I can assist with? I mean, it's a pretty straightforward investment. I know we've gone through it pretty quickly tonight. But if you're looking for international exposure, it gives you that. If you're looking for something that can perform in market uncertainty, it also gives you that. It's fairly straightforward. Max risk, there is. Mike's asked me the question, what's the maximum risk on this investment? I don't believe that there is. I mean, it might be. It might cap out. You might be $5 or $10 million, Mike, somewhere in the vicinity of that. I'm not sure if there's any cap with the way the investment banks structure this. Okay, so Mike, and the maximum, let me go back to the maximum risk is the investment amount. So 22,950 is the maximum risk. All right, so Mike, sorry, to answer your question, that is correct. It's 22,950 if you want $100,000 of exposure, maximum risk. All right. Now, just one second. Someone's asked me a question and I need to reference something to answer their question because it's just slipping my mind. Just one moment on Neil, and I'll give you an exact answer. Sorry, Neil, I'm just getting my piece of paper. Mike's asked the question, quarterly liquidity back to the issuer. Okay, so the way quarterly liquidity works, Mike, is you're using over-the-counter options in this. The structure of them I'll explain regarding your specific questions. But in an instance of liquidity, so say you want to close out of this or it early, you really, Mike, you can call me up, or you can call up the advisors any day of the week, and I'll get in contact with the product manufacturer and ask for liquidity that day. It might take a week or two to enact. So if someone wants to close out early, it's usually an emergency or something like that that's come up and they need the money, then we go back to the product manufacturer and we unwind the position. It doesn't, we say quarterly, but it can be, we've got a pretty good relationship with the manufacturers, so we can do it straight away. I hope that answers your question. I mean, one of the things about the way that we structure these investments is they're meant to run full term. However, if they run really strongly, you go to a delta of 1 and you can close out of it early, and that we have in some instances seen that occur. So if gold went for a really strong, we don't have to wait till the third year, we can close out of it early. That definitely can be the case. All right. Okay. Is there any other questions? Anything else I can assist with? All right, well, I'm not seeing anything else. Oh, Neil, you did ask the question. So the way that gold is accessed, it's based off the London Bullion Market Association gold price, right? So it's tied to that particular gold price. All right, wonderful. Now, thank you very much for all attending tonight. Again, we think this is a very interesting investment. If you would like to get the PDS sent through, just type in yes, we'll get that sent through. If you're someone that has done these types of investments with us before and you would like to get exposure, just put in the exposure amount into the chat box and I will get the guys to pre-fill your paperwork and send it out so that you can read through it, confirm it. From there, you've got a week or two to move on this one. If you've got any further questions, speak to Michael in our office here and he can run through any detailed question and you know, of whatever nature. If it's a very, very technical one, we can go back to the product manufacturers and get any technical questions answered. But as far as the layout of this, Michael Kay is very, very well versed in it. Thank you very much for taking the time to be here tonight, and we look forward to speaking to you all again soon. Cheers.